Welcome to Daily Wisdom from the Flippening podcast. These episodes feature short, to-the-point clips from our full-length interviews. We talk to the men and women behind the trades, crypto exchanges, and regulations with the goal of helping you become a better, more informed investor.
Hi, I'm Michael Kaplan, editor of the Flippening podcast. Today's episode is from a 2017 conversation with Kyle Samani, co-founder and managing partner of Multicoin Capital, a crypto hedge fund based in Austin, Texas. We discuss Kyle's concept of managing a liquid venture portfolio. For the full conversation, check out Flippening episode 2. And now without further ado, our conversation with Kyle Samani, co-founder and managing partner at Multicoin Capital. Enjoy.
Our thesis is that crypto is a fundamentally new kind of capital market. We have never before had high risk, high reward, early stage technology investing that's liquid. And liquidity changes everything about portfolio construction when you think about high risk, high reward investing. The entire kind of VC model is predicated on a lack of liquidity. 10-year lockup, obviously because the underlying assets are illiquid. And therefore, when you're a VC, basically once you invest, basically the money's gone and hopefully you get it back one day. It's extremely risky. All your outcomes are very binary. You have no control over the exit price. You can't change your mind after the fact, right? And so when you think about portfolio construction and venture capital, you basically need to be investing in at least 20, if not 30 companies out of a portfolio, right? Just thinking about risk and like you basically the goal is to catch a winner.
And you got like 10 to 12 year lockups and, you can't get your money out and all that stuff. Yeah.
Right. And so that's one problem. And there's a whole bunch of reasons why that model is designed the way it is. But here it's liquid. And so the first thing LPs are going to say is, why would I commit to a 10-year lockup? The underlying assets are liquid. Like, that's crazy. Even though you could try and kind of be pedantic and say, well, you just don't know what you're doing and we're the tech guys and we really know what we're doing and just like we need a long lockup. Like maybe you'll convince people to give you money in those terms. I haven't tried to do that. I'm not sure who would agree to those terms, but hey, you're welcome to try. So we have a 1-year lockup on our fund, and it was just because we want investors who are willing to commit given the volatility. But like knowing we have a 1-year lockup, knowing we have month-to-month NAVs, and that we will be judged on our performance, and our LPs expect returns on a reasonable time period, it's kind of hard to think purely like a VC. It's actually counterproductive. So we think of ourselves as managing a liquid venture portfolio. And so our investment and how we kind of handle that on our investment process is we have a unique 2-step investment process. Step 1 is, do we want to own the asset at all? And this is a function of venture style thinking. So what's the problem? What's the solution? How does the technology work? What are the technical risks? Who's the team? If it works, how big can it get? Those kinds of things. We aim for 100x in everything we invest in. Obviously, we will not 100x everything, but we need to see a return on that order of magnitude to justify the risk because the things we're investing in are very risky. So that's kind of step 1. And then step 2 of our investment process is, okay, we've got this bucket of about 20 to 25 of these things that we think are, if they work as advertised, could become very large. From there, then we basically say, okay, well, of these 20 to 25 things, what do we want to be overweight versus underweight today? And this is kind of thinking with the hedge fund hat on, thinking opportunity cost of capital. So there are certain assets in our portfolio that we're overweight on today. There are certain assets that, although we are very bullish on them in the long run, our allocation today is actually 0 because we don't believe there's any short-term price catalyst. So that's kind of how we think about managing a liquid venture portfolio.
What do you think is easier and harder about what you're doing, versus a traditional hedge fund? So obviously trading is harder. What other things might be harder and easier? Like when you sit down and you talk with someone from Wall Street or a hedge fund manager, where are they jealous and where are you envious?
Yeah, so I'm envious of like all the infrastructure they have to do things. Like for us, we're hiring a trader, right? Right now we're like debating, do we hire a trader? And if we do, like the amount of security implications that has, like we have to structure the system so that the guy can't run off with all the money. That's just a big problem that like is not, no hedge fund manager is like, oh yeah, my trader's going to run off with all these Apple stock certificates. Like no one thinks that. So I'm just generally envious of the entire financial infrastructure that traditional hedge funds have. So prime brokerage, leverage, shorting, all that stuff, right? Like is all like in one, like fund administration, like reports, all that stuff is all totally price availability. Nothing is standardized. Like I don't have any tools that like really work. And so I'm envious of that stuff. They're envious of like the obvious one is returns. And I would say like I could have 1/10 of the IQ of a guy trading equities and I'll probably outperform him just because like I'm in an exponential asset class that like is going to change the world. And if you're just like trading equities in a very efficient market, good luck outperforming the exponential thing that's going to change the world. In that sense, I have it easier. But I just have a new set of problems. I think where my job becomes just different is actually evaluation, both technical, technology, but then also like how does value accrue? Value will accrue to these token things in a very different way than accrues to equities. There are no revenues or expenses or EBITDA. Like we're buying currencies that are priced against other currencies. And so figuring out demand for currencies and the willingness of people to hold the currency is just a very different form of thinking. And then like how we get involved and actually generate real alpha. So I work with, right, like if you're in a hedge fund and you're invested in like, I won't use Apple as an example, that's too extreme, but like if you're invested in company number 300 of the S&P 500, you might get the C-suite on the phone or like some guy from investor relations to like ask questions. But like you're not really value accretive in any way. You're just like a guy on the sidelines who like demands returns. I get on the phone, like I had a phone call this morning with one of our investments and we spent about an hour on the phone with them, and probably 75% of the phone call was them telling me their problems and thus, brainstorming on how I can help them solve their problems.
That's it for today. If you like what you heard and want to support the show, please consider leaving us a review on iTunes, Stitcher, or wherever you listen to podcasts. If you decide to leave us a review after subscribing, we'll send you a free Nomics t-shirt. Just hit us up on Twitter at username Nomics Finance after you've left the review, and we'll hook you up. You may also be interested in Nomics.com, our crypto market cap and pricing website. Check us out at Nomics.com, spelled Nomics. Now stick around for our legal disclaimer. All opinions expressed by podcast hosts or guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions. The producers, hosts, and guests of the show may maintain positions in the companies or assets discussed today.